Hey there, everyone. This week was a pretty fantastic week for risk assets. The S&P, the Nasdaq 100 both made new all-time highs. The Dow Jones Industrial Average briefly peaked above 40,000 for the first time in market history. But is the advance that we're experiencing sustainable? We have two general ways of approaching a market that is showing remarkable strength like we are now. Number one, you project highs, which I've not personally found to be a particularly profitable approach, because when something reaches my target, as long as the trend is still going, I'm going to want to hold it. That leaves us with trend following. I'll share with you some of the things I'm looking at to determine when this raging uptrend may subside. Before we get to the charts, here's one more thing I wanted to tell you about. I'm a technical analyst, which means I spend hours every day looking at hundreds, if not thousands of charts. But in my own decision-making process, it's not purely technical. I actually spend a decent amount of time looking at fundamental factors that are actually driving companies and empowering them to grow for multiple years going forward. I look at macroeconomic data like the Fed and inflation and interest rates to think about how all those factors might impact those stocks and ETFs that I'm looking at. And I also have learned from spending years working with institutional investors that having a good quantitative model is super important. What a quantitative model does is basically look at the characteristics of successful stocks, looks at all the factors, technical, fundamental, everything, and wraps it into one rating, and then allows you to focus on the best opportunities within a particular set of stocks or ETFs. The good news is, as an individual investor in 2024, you have access to a pretty decent quantitative model through Seeking Alpha. If you go to marketmisbehavior.com/seeking alpha, you'll be able to take advantage of their quantitative rating. They actually have a pretty sophisticated quant model that is driving their quant rating. You can then cross-reference what we're talking about on this video, is looking at the charts of leading stocks, looking for big base breakouts and good technical opportunities, but also look to see if the quantitative model from Seeking Alpha supports the upside potential of those names. So go to marketmisbehavior.com/seeking alpha to find more information. Usually get a better deal for you. It's an affiliate link, which means that helps me make Market Misbehavior awesome, and we're all happy. So check it out, and let's get back to the charts here. So what a difference a couple weeks makes, right? In mid-April, we're thinking all about breakdown scenarios. The S&P had gone from a new high around 5250, just slightly above there, undercut its 50-day moving average, undercut recent swing lows, and appeared to be on the way to much further downside. We had a downside target around 4,800 based on a first Fibonacci retracement level, but something happened here the last couple weeks in April, and arguably a combination of inflation data that was not too strong and actually fairly stable, suggesting that the actions of the Fed have taken hold and that they will actually be able to lower rates at some point. Long-term interest rates, 10-year yield, for example, coming down. The dollar, instead of strengthening, started to weaken. And so overall, the last couple of weeks have been a very hospitable environment for risk assets, particularly equities like the S&P and the Nasdaq. Now that the S&P and the Nasdaq have broken to new highs, what do we see as further upside? Well, generally speaking, you can either go with price objectives or price targets. And these are common in the financial industry. You'll say, okay, I think this stock could go up 50%. Here's my upside target. And the technical toolkit has many capabilities to try to take the price action we've observed so far and to project an upside target as a result. Personally, though, I found that to be not particularly helpful, and that's from a career spent working with growth-oriented money managers. When something would go up 20, 30% and it hits some arbitrary price target, none of them would want to sell, because there's a chance it could go up another 20% or another 200%. There's no way they would touch something. It goes back to that basic principle of leaning into what's working, leaning away from what's not working. Peter Lynch famously said, compared it to growing a garden, right? If you want your garden to thrive, you wouldn't pull your flowers and water your weeds, but that's what you're doing if you sell your winners and hold on to your losers. So what you want to do is you want to water those flowers and nurture those. You want to pull your weeds. So things that aren't helping your portfolio, you unwind those positions. Things that are helping you gain and outperform, you lean into those and you continue to grow your portfolio just like you grow a flower bed. Now, what do we do in an environment where the market's making new highs? Well, I would say you become a trend follower and you focus on the trend. And, from a high level, we're looking for the trend to continue. And this goes back to Charles Dow's original work, thinking higher highs and higher lows are an uptrend. We've made a higher high for the S&P and the Nasdaq. We will pull back at some point. do we make a higher low? And as long as we pull back and make a low above 49.50, 5,000 on the S&P, that's still technically an uptrend. I've made this chart which combines that trend analysis on the S&P with two other metrics that I think could be very helpful right now. One is to look at the bond markets, particularly the high yield market. The other one's looking at volatility, and we'll compare that to the S&P itself. So this might be a different chart. Let me explain what these three data series are showing you. Now at the bottom, going from bottom up, we have the S&P 500 on a closing basis. Pretty intuitive. We kind of know that chart, so hopefully that's not too confusing. We're just looking at the closing values over the last 2 years. Here is the VIX. Volatility, we've talked about the VIX on this channel before. I've plotted it upside down, and if you're wondering why I've done that, that's because when the market conditions are strong, like we saw coming off of the October low last year, first quarter of this year, look how the VIX remains very low, kind of in that 12 to 14 range. But then when the market starts to see more of a risk-off scenario, more starts to rotate down, you see the volatility increases. So by plotting the VIX upside down, it's a great way to actually relate the movements in the VIX to the thing I'm really interested in, because I want to be betting on the S&P 500 or stocks in some way, right? I'm trying to think about how much I want to own or not own stocks in any particular time. So by plotting the VIX upside down, I can bring it more in line with what the S&P is actually doing. Now, if you're wondering how you do that, different charting platforms are a little different. On the StockCharts platform, you just put a little minus sign before the ticker, and it will plot something on an inverted scale. It's really helpful when you're trying to chart an inverse relationship instead of showing sort of that spaghetti chart where things kind of come in and out and come together and come apart. I like to chart the one upside down so they're actually moving together. So if that would make sense intuitively in terms of that defining that inverse relationship, as we'd call it. Now, the top, this may be a series you're not familiar with. This is an index from Bank of America called the High Yield Index Option Adjusted Spread. And if that's a scary group of words you've never seen mixed together, let me simplify it for you. We'll start at the end. An option adjusted spread. A spread is basically a premium, for lack of a better term, that bonds will trade at relative to a risk-free rate. So if you don't want to take on any risk, you could buy a U.S. Treasury bond. While there is some risk implied in the U.S. government for sure, in bond terms and in market terms, it's generally considered kind of a risk-free rate. High likelihood that the U.S. government will be able to pay their debts. There's a very low, if minimal, if any chance that they won't be able to meet their debt obligation, mainly because they can print essentially an unlimited amount of money. So chances are very, very high, if not almost 100%, that the U.S. government will fulfill its debt obligation. If you buy a Treasury bond, pretty safe that you're going to get it. But when you look at an individual company, there are a lot of risks that are involved, right? The company risk as we think about it. So not all companies are particularly consistent at paying back their debt obligations, paying those coupon payments that you get if you own a bond from a particular company. So bonds are quoted on a spread. If I'm yielding 2% on a Treasury bond, but my corporate bond pays a yield of 4%. So I have a higher yield because it's a riskier instrument. The spread is 2%. 4% on the corporate bond, 2% on the Treasury bond, 4 minus 2, there's your 2% spread. So bonds are quoted on a spread basis because you're thinking about what additional yield you get beyond a risk-free debt. So that's what the spread means. Option adjusted spread just means that certain bond structures, they're not all just bullet bonds, meaning they pay back a coupon payment and then pay you back the principal at the end. That's how a normal bond would work. There are also call options that can happen. So the bond can actually be called in the middle before maturity. And so an option adjusted spread basically just means you exercise all those options. So it basically takes the options out of the picture. So you're comparing bonds and quoting the spread on an apples to apples basis compared to other bonds. High yield index is basically, high yield is another word for junk bonds. These are the bonds of risky companies. So high rated companies, like a AAA rated company with great credit. Think of a person with a great credit score. They are considered a AAA rated, a high rating based on the credit rating agencies. Junk bonds or high yield companies are lower. They do not have as good of a credit rating, company speaking wise. And as a result, there is an elevated chance, or certainly a higher risk, that they will be unable to pay back their debt obligations. So to put all those words together, we are looking at the spread adjusted for any options. So basically, what's the spread above a risk-free Treasury bond for this index of high-yield bonds or bonds of risky companies? look at the values here. So right now, the high yield index OAS that I'm quoting here is around 3.1%, which means in general you're getting 3.1% above a treasury bond or a risk-free bond to own these risky companies' debt. So what does it mean when the number is going up? That means spreads are widening, and that means bond investors are thinking of it as a more risky environment. They think it's a higher likelihood that the company is going to struggle to meet their debt obligations. As a result, they want more and more of a spread. They want a higher yield for taking on that additional perceived risk. So as a result, the spreads get bigger. And on this chart, because I've plotted this upside down too, the line would actually go down. If the line's going up, that means the spread is narrowing or tightening. And what that means is basically bond investors are seeing less of a risky environment. They think higher likelihood that the companies can be able to meet their debt obligation no problem. As a result, they don't need as much of a compensation for owning these risky bonds. So there's your high yield bond 101 sort of discussion. So what does it mean that the spreads are the narrowest they've been for the last 2 years? That means that bond investors who tend to be laser focused on risk, because that is the game, is identifying the chances of companies not being able to repay their debt, they're perceiving a very low risk environment. They're seeing that conditions are good, companies are in pretty good shape. As a result, very low risk. So when high yield spreads are narrow, when volatility is low, that usually lines up with a bullish market phase. And you can see that, for example, from November of last year through April of this year, spreads are tightening or narrowing, volatility is very low, and as a result, that's pretty much implying that stocks are probably going to go higher because conditions are fine. But look at what happened in August, September, October of last year. You see spreads started to widen. You see volatility started to increase as the VIX got all the way above 20, and that, of course, coincided with stocks going down. So why is this an important chart to watch now? Because as of this moment here in mid-May, it's quite bullish. Spreads are very low or very narrow. Volatility is very low, which means conditions are fine. It's a low volatility uptrend, and stocks are going up. So what would you look for? What would be your danger sign as a trend-following investor? Number one, spreads widen. Bond investors start to think there's elevated risks that maybe are not as obvious to you looking at stocks and benchmarks on their own. Volatility maybe starts to increase. If the VIX starts to go up, which would mean the line's going down on this chart, that would imply that investors are getting more anxious, getting more nervous, and as a result, they're tending to trade a little more actively. Volatility is starting to increase. Most important one, in my opinion, the market stops going up, right? And go back to trend following 101. An uptrend is a pattern of higher highs and higher lows. We've now made a new high. Do we pull back and make a higher low? When that stops happening, which means on this chart, S&P below 5,000 is no longer a particularly good chart. That's a little bit of ways away from where we're at, almost at 5,300 right now. But those are the three data points I might follow right about now in mid-May to, number one, confirm the current bullish structure, and then look for what I call a change of character. When this chart starts to look different, that may be the time to take some risk off the table in your own portfolio. For Market Misbehavior, I'm Dave Keller. Have a good one. We'll talk to you again soon.